The Russian conflict is causing the whole market to get beaten down. And that's just adding to the year-to-date losses where the S&P 500 is down 10% year-to-date and the Dow Jones is down 9% year-to-date. So my question is, especially for someone who's like myself, who's around 70% in cash right now, is it time to buy the dip? Well, Mohammed Eliran discusses that with Bloomberg News. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? And I really hope that one day this channel gets large enough that I can interview people like Mohammed Eliran myself, because the first thing I'd ask in this environment is, with all the impacts to the Russian stock market, Russian company share prices, and the Russian sovereign bonds, have we seen the impacts of the Russian sanctions, or is this something that we should wait to see play out? Here's Mohammed on that question.
In terms of markets and the economy, we are yet to see the full impact of what's going on in markets, on the economy. And when I say in markets, John, I even include the ruble and what has happened to Russian assets. We are still early in the process. This thing, unfortunately, doesn't go away soon because no one can figure out what the off-ramp is for President Putin.
Now, I've been thinking, with the price of oil only going up to $105 per barrel, when I thought it was going to go to something like $150 per barrel if there was an invasion, have I overestimated how big of an impact these sanctions could have on Russia? Or is the market underemphasizing how significant these sanctions can be on the global oil production? Here's Mohammed Eliran on that question.
So first of all, never underestimate the power of crippling a payment system. It brings the economy to a halt. We felt it in 2008 when it was counterparty risk between banks. That impacted the banking system. Russia is now having its payment system crippled, and that brings to a halt a whole series of things. The energy markets still believe that you can have a carve-out. They still believe that you can have an effective way of shielding energy supplies. Let me tell you, for someone who has lived through various dislocation, it is very difficult to be surgical in the midst of such disruptions to the payment system. So I think we still are overestimating the amount of energy that's going to be supplied to the marketplace unless other producers increase output.
And with the continued sanctions on the Russian economy, some of you guys in the comments have been asking me if we should be investing in Russian companies. In fact, that's the reason why I even decided to make this video. I wasn't going to make a video today, but I just wanted to get this one out there because some of you guys are really considering buying into Russian companies. And so I won't say it. I'll let Mohammed Eliran say it for me.
Where are you looking for signs of stress at the moment, Mohammed?
So, of course, it is, first and foremost, it's in Russia. It is everywhere in Russia. It is an uninvestable place in terms of virtually all financial markets. It is in those exposed to Russia, and we haven't yet seen the full impact of that, but you've been talking about European banks. We've seen quite a few mutual funds get hit quite hard, and that's sort of round one. Then keep a very close eye on flows. Figure out where is the pain trade and who's going to try to get back on side.
And for those people who are invested in Russia, it looks like there's a bunch of investors looking to take their money out of Russia. The interview asked Eliran a great question regarding the spillover impacts from a rush to exit, because it looks like right now most people can't take their money out of the Russian stock market just yet, but that's going to change very quickly. Here's Mohammed Eliran on that point.
Mohammed, when you get a series of people, investors and companies, lining up to dump assets all at once and the gates are closed, traditionally in history, what are the spillover, the consequences from that?
So when you can't sell what you want to sell, you sell what you're able to sell, and that's how you get contagion. So it's one thing for, let's take a mutual fund that has been caught offside in Russia. It's one thing for the mutual fund to tell investors, we can't sell our Russian assets and we're going to maintain what we think is long-term value. That's fine. I can understand why they'll say that. But what happens if the investors start taking out their money? Typically, these mutual funds are forced to raise liquidity, and they have one of two choices. Either they sell other stuff and that's how you get contagion. Or alternatively, they put up gates, which is a massive business decision. So, these things don't happen immediately. I can take you from crisis to crisis, where prices react first, market liquidity reacts second, and then third are flows. So that's why I think it's critical to keep an eye on flows, because that's what causes contagion if we start getting outflows.
Now, switching gears a little bit, in a previous Mohamed El-Erian interview that we saw on this channel, he discussed that the invasion into Ukraine would increase stagflationary winds. I'm very interested, and I'm sure you guys are as well, of what his thoughts are on stagflation now that the Ukrainian invasion has happened.
And then longer term, John, this is a significant increase in the stagflationary winds blowing through the global economy. The marketplace today is, I think, relieved that that means that the Fed will tighten less, and I think that's correct. I always thought it was ridiculous, this notion that they would tighten 8 to 9 times this year. I think the marketplace now sort of is coming down to a more reasonable amount of tightening.
Okay, so with that, Mohamed El-Erian expects that the Fed is going to tighten less. But what exactly is it about this invasion that hasn't made it more likely that the Fed is expected to tighten less? If we believe that this is increasing the stagflationary winds, and thus we would have more inflation in the economy, wouldn't they tighten more in this environment? That doesn't really make a lot of sense to me, and I want Mohamed El-Erian to explain that a little bit more. So here's him on that point.
What the marketplace hasn't recognized is there's a reason why the Fed will tighten less. It's not because inflation has a better outlook, it has a worse outlook, is because growth has a significantly worse outlook for the global economy.
So that makes a lot of sense. One of the reprieves to the inflationary impacts is that growth is going to be slower. So that's a little bit scary, especially for those of us who are more invested into the securities markets. So now the thing that scares me is that with the Fed hiking slower because they see slower growth on the horizon, does that mean that we have more trouble for longer, potentially into 2023? The interviewer asked El-Erian just that question.
More broadly, Mohamed, on the last point, we seem to be taking some comfort. This was the point you made moments ago, from a Federal Reserve that maybe doesn't do 7 hikes this year, it does a few more. Perhaps doesn't hike 50 and only hikes 25. That's the short-term story. Does that just lay the ground for more problems? Does that become more problematic at the end of this year, Mohamed, going into next year?
Yes, I mean, remember, we entered this in the Fed in a hole of its own making. We no longer had a first best policy response because the Fed was late and missed the orderly windows. Now the Fed faces an even bigger challenge. In the short term, I think rather than slam on the brakes and cause a recession, they're likely to opt for tapping the brakes, but that means that the inflation issue becomes more persistent, and that has its own consequences. So that's why I'm saying, John, it's early in the process. I understand people who want to buy the dip. I understand this notion that the Fed will be less hawkish. I understand the valuation argument. I understand all these things, but in reality, we're looking at so many potential outcomes, with technicals playing a much bigger role and not being offset by stronger fundamentals. The fundamentals are weaker today than they were a week ago.
So with this interview, it looks like we're entering into a more unpredictable environment. So what exactly am I going to do here? I think the strategy for myself is to look for really strong companies that are trading for a real significant discount to their intrinsic value. So I've been sitting on the sideline for quite a bit now. The cash pile is adding up. It's at around 70% cash of the portfolio right now. But I won't let that cash burn a hole in my pocket. I'm going to wait for these real high quality companies to start trading at approximately 50% of their intrinsic value. Now, there were certain times where Google came down to 75% and other names like that did come down. So could they come down a bit more? I absolutely believe they can if there's a big shock to the economy. And so I'll be waiting. And when that happens, I'll have the assets to deploy. So until then, I'm going to remain cautious and wait for the stocks to come to me in this environment. And so guys, I say this all the time. If you are receiving value from this channel, please consider subscribing, as it really helps YouTube grow the channel. Also guys, if you haven't done so, please hit that like button. And if you want to see the previous interview for Mohamed El-Erian that I have mentioned on this channel, you can get to that video right here.